Welcome back to Curious Commerce. Let's continue the topic Sources of Finance, Part 4. The next long term source of finance is venture capital financing. Venture capital refers to finance provided to startups, but is provided to high risk and high growth businesses. Venture capitalists expect high returns. They also accept high risk. The thumb rule, the high risk, high return. The venture capitalists often take part of management. They provide guidance and expertise in the business. The methods of venture capital financing. Equity financing involves purchase of equity shares. The venture capitalists became the part of the owners because they have purchased the equity shares. The second type is conditional loan. Conditional loans carry royalty on sales. Repayment depends on performance. For the specific reason, they are giving the financial assistance. The thing we called as in the conditional loans. Income notes combine features of loan and equity. The last method is participating debentures, allows profit sharing. The next, the source of finance is lease financing. Lease financing is a method of using assets without purchasing them. Lease financing is a method of using assets without purchasing them. The owner of the asset is called the lessor. The user of the asset is called the lessee. The lessee pays a periodic amount called the lease rent. Ownership of the asset remains with the lessor. Operating lease is for a shorter period. It is cancelable in nature. It is cancelled at any time. Financial lease is for a longer period. It is non-cancelable. In general, lease agreement will be cancelled at any moment, but the financial leasing is non-cancelable. Lease financing reduces the initial capital requirement. It is commonly used for machinery, vehicles, and equipment. The next one is the asset securitization. Asset securitization is the process of converting liquid assets into marketable securities. It is mainly used by banks and financial institutions. Loans such as housing loans or receivables or pooled together. These pooled assets are converted into securities. These securities are sold to investors. This process improves liquidity for the originator. Asset securitization also helps in risk management. It releases blocked funds. That's why the asset securitization is the major sources of the next source of finance is international finance. International finance refers to funds raised from foreign markets. It is generally used by large companies or the MNCs, multinational companies. Global depository receipts are issued in foreign markets. It is famously called as in GDRs, Global Depository Receipts. American depository receipts are used in United States or USA. It is famously called as an ADRs, American Depository Receipts. External commercial borrowings are called as an ECBs or loans taken from foreign lenders. International finance helps in raising large funds. However, it involves foreign exchange risk. Companies must be careful while using international finance as the sources of finance. Let us now discuss about short-term sources of finance. Short-term sources of finance are used to meet working capital needs or the working capital essentiality for the specific period. The duration is usually less than 1 year. These sources help in maintaining day-to-day operations of the business. They are also used to meet seasonal fluctuations. Short-term finance is essential for smooth functioning of business. So let us discuss one by one trade credit and advance from customers. Trade credit means purchasing goods on credit from suppliers. The buyer is allowed time to pay. This reduces immediate cash requirements. It is the most common source of short-term finance. Advance from customers refers to money received before delivery. It acts as an interest-free source of finance. The next one is discounting of bills of exchange. A bill of exchange is a written instrument used in credit sales. It contains an order to pay a certain amount on a future date. When a business needs immediate cash, it can discount the bill with a bank. The bank pay the amount after deducting discount charges. The seller receives cash before the maturity date. This helps in maintaining regular cash flows. Discounting of bills is widely used in trade. Next, short-term source of finance from bank overdraft, generally called as in the OD. Bank overdraft is a facility provided by banks to current account holders. It allows withdrawal of money beyond the available balance. The overdraft is allowed up to a fixed limit. Interest is charged only on overdrawn amount. Overdraft may be secured or unsecured. It is based on the account holder capability and willingness. Clean overdraft is granted without collateral based on reputation of the account holder. Overdraft provides flexibility in managing working capital. The next short-term source of finance is cash credit, famously called as in CC. Cash credit is a continuous loan facility provided by banks. It is granted against security of stock and receivables. The borrower can withdraw funds as and when required. Interest is charged only on the amount actually used. Cash credit is the most popular source of working capital finance in India. The next short-term source is LC or letter of credit. A letter of credit is a guarantee given by a bank. It assures the seller that payment will be received. It is mainly used in international trade and commerce. It reduces the risk of non-payment. The bank makes payment on behalf of the buyer. Next, short-term source of finance is bills finance and working capital demand loan. Bills finance refers to financing against bills arising from sale of goods. Banks purchase or discount these bills. Working capital demand loan is provided for a short fixed period. It meets sudden working capital needs. Interest on WCDL is generally lower than cash credit. Next one is the factoring. Factoring is a financial service involving sale of receivables. The business sells its invoices to a factor. The factor provides immediate cash. That factor also undertakes the collection of debts on behalf of you. Factoring improves liquidity, it reduces credit risk. The major types of factoring: recourse factoring allows the factor to recover money from the seller in case of default. Recourse factoring: the risk of bad debts remains with the seller. Non recourse factoring transfers the risk of bad debts to the factor. The seller is protected against default. Third one is the advance factoring, provides immediate advance against invoices. Fourth one is maturity factoring. Maturity factoring makes payment only on due date. Finance factoring provides only financial service. Non-notification factoring keeps the customer unaware of factoring agreement. The next popular short-term source of finance is commercial paper. Commercial paper is an unsecured money market instrument that is used by financially strong and reputed companies. Commercial paper is used in the form of promissory note. It is issued for a short period ranging from 7 days to 1 year. It is issued at a discount. It is redeemed at face value on maturity. For example, the commercial paper face value is 100 rupees. It is issued at a discount of 5%. It means it is issued to the common man at 95 rupees. When it is matured, the investor received 100 rupees. That is equals to face value. Commercial paper is a cheap source of short-term finance. It is not available to small or weak companies. It is for best track record companies. The next source of short-term finance is advance against goods and document title. Banks provide advances against physical goods such as raw materials or finished goods are pledged as security. Banks also provide advances against document of title. Examples include railway receipts and bills of lading. These documents represent ownership of goods in transit. Such advances help in smooth flow of trade. Advance against supply bill and export trade. Supply bills arise from work done for government departments. After completing the work, bills are raised. Banks provide finance against these supply bills. This helps contractors meet working capital needs. Export trade requires large finance. Pre-shipment finance is provided before goods are shipped. Post-shipment finance is provided after the shipment. So this is also the major source of short-term finance. Next one is the intercorporate deposits, ICDs. Intercorporate deposits or short-term deposits. One company deposits surplus funds with another company. These deposits are usually unsecured. They carry higher interest rates compared to bank deposits. Intercorporate deposits helps companies manage short-term surplus. Next one is certificate of deposits and public deposits. Certificate of deposits is a negotiable money market instrument. It is used, it is issued by banks for a fixed period. Certificate of deposit carries a fixed rate of interest. It can be transferable easily. Public deposits are invited directly from the public. They are regulated under the Companies Act of 1956 or 2013. Public deposits are a key source of finance. However, they involve risk also. The other sources of finance. Seed capital assistance is provided to new entrepreneurs. It helps in starting new businesses. Internal cash accrual refers to funds generated internally, means that within the organization. Unsecured loans are loans taken without security, without the collateral things. Deferred payment facility allows payment in installments. Capital incentives are provided by the government. Accrual account or provisions also act as short-term source of finance. The new instruments in the market, green bonds are issued for environmentally friendly projects. That is also source of finance. Social bonds are issued for social development activities. Sustainability linked loans are linked to performance targets. These deep discount bonds are issued at heavy discount. Zero interest and zero coupon bonds do not carry interest. Floating rate bonds have variable interest rates. These instruments reflect innovation in financial market. Source of finance are essential for every business. Different sources are used for different purposes. Each source has its own advantages and limitations. No single source is ideal in all situations. A wise financial manager selects an appropriate mix of finance, Sound financial decisions ensure growth, stability, and survival of business. Finance is the backbone of business. Selection of proper sources of finance is a key managerial function. A balanced mix of sources ensures growth and stability. Thank you for learning with Curious Commerce. This is the overview of source of finance, include long-term source of finance, medium-term and short-term source of finance. In upcoming classes, we discuss one by one deeply. If you need daily updates, follow Curious Commerce Financial Management Hub and WhatsApp channel. Please share and subscribe to Curious Commerce to know the commerce and economics related to the business, entrepreneur, or in macroeconomic nature. Thank you all.